Okay, ready to get started. All right. So, everyone's favorite subject, taxes. Now, I don't want to be in a hurry on this chapter, and I know we have it scheduled for just 2 lectures, but in my mind, I'm thinking if for any reason we need to slow down, I have no problem turning it into 3 lectures instead of 2. Because even though a lot of people feel that this is the worst chapter as far as the most boring information and will cause you to fall asleep, it actually is a lot of important things that you're going to get out of this chapter about taxes that are going to be beneficial later on in life that you may or may not remember. I'm not sure. But one of the things I did when I first graduated from college is, like the very first year that I have a real job and I'm making real money, I went to a tax professional and had them help me do my taxes so I would know how it's done right. And then from that point on, I did my own taxes, and the benefit of doing your own taxes is you get to learn exactly how taxes are done and how you're being charged taxes so you can start making decisions to legally avoid taxes. And through that process of learning exactly how taxes work, I've saved upon thousands of dollars over my lifetime by making certain decisions to avoid taxes, and I mean legally. It's knowing how taxes work that you know there's different decisions that can be made to avoid taxes. And then every time the tax laws get changed, somebody's posting information how, well, this just means now you have to do this to avoid that tax. Legally, there's always a way to avoid different taxes. Not all of them, but a lot of them. And so it's just a matter of understanding. People who make a lot of money, they make sure and understand every possibility to avoid as much taxes as they can, and that's how they put as much money in their pocket. I remember someone was running for president a few years ago, and it was a big deal because their taxable income or their taxes were so low compared to they made a ton of money. And it's because they knew the tax laws, and they knew exactly how to have a certain amount of money in a trust, have a certain amount of money in these tax-free investments, have a certain amount of money in this and that. They owned a home. They knew exactly how much the interest on a loan would be you can write off on your taxes. All of these things they knew, and that's how they were able to bring their tax obligations so low compared to their income and save thousands. And that's what I do too. I do the exact same thing. By understanding how taxes are done, I make decisions to avoid those taxes purposely because I realize how much that means more in my pocket. When you make $1, if you take the state tax and the federal tax and add it together, you're looking at around an average of about 25 to 33% of your money is gone in taxes. And that you're only keeping that, I forgot, there's Social Security and Medicare. You're really looking at about 35% of your money's gone in taxes. And you're only really putting about 65% in your pocket. So, you know, it's how much of that 35% you can avoid by doing certain decisions. When you first graduate, if you're anything like me, you know, I owed student loans. I had my, I had my first real car, and I had a loan on that too. I owed more than I was worth. I had a negative net worth when I graduated from college. And so I had bills to pay, and so you're not thinking about taxes that much. But when I started making raises, and I was such a poor college student that I kept living like a poor college student when I graduated so that I could save as much money. And when I finally got to a point to where I saved some money, I started going, oh, this is how I can keep a bunch of it in my pocket instead of paying in taxes, because now I see I should be investing this way, or I should be looking for a house, or I should be doing this and that. You wake up when you start accumulating money to how can I keep more of it in my pocket instead of paying it in taxes. And then they keep changing the law, so you've got to keep adjusting your plan. And that's what this is going to be. I'm going to try to introduce you to taxes, the basic concept of taxes. And maybe the light bulb will click somewhere through this lecture, with this subject, that down the road, when you guys are making more money you've ever made in your whole life, some things are going to start clicking and going, okay, I should be doing this now and this now, because I'm getting tired of all my money going to federal and state government for taxes, possibly. You want to pay your fair share. We all want to pay our taxes because of the services that are being offered. But there's a lot of, there's a fair share, and then there's overpaying. And if you're paying the maximum because you don't know about all the loopholes that are legal, then you're kind of overpaying compared to everyone else who does know all the loopholes that are legal. All right, types of tax. What? Was that, forget where we're going here, slide 3. Every time you buy something in our state, you have a tax. What percent do you pay every time you go to pay for something in Michigan? That's not, there's some of them you don't have taxes like groceries, but what is the tax? What percent? 6%. You guys are so young. I don't know if you remember. You're so young, but for almost my whole life, before, I don't remember what year, it was 4%. It was like 4%, 4%, 4%, and then all of a sudden it got changed to 6%. And that was a big deal for a lot of people. And now everybody's so used to it, 6%, that it's nothing, right? You guys are so used to paying 6%, you don't think anything of it. But I remember it was 4%, and that 2% is a big deal. Okay, so there's taxes on purchases. Yes, there are some states that do not have taxes on purchases. But they make up for it in another way, and it could be their state income tax. There's some states that don't have state income tax, but they make up for it in another way, and that may be a higher percent on purchases. A lot of states who have a lot of vacationers come there will do that. They'll say, we don't want to do the state income tax on our residents because we have so many people come to our state for vacation. Let's make up for it by having a higher than average sales tax on purchases. That way all these visitors are paying the state tax instead of our residents. It was a big, people who live in Florida were going, yeah, all right, come on down to Florida. Pay our state taxes for us. And that's how it works down there. I don't know if they still do it that way. Has anybody been to Florida lately? And know if they had to pay sales tax on something? No one? All right. So that's purchases. Property taxes. Yes. When you own a house in most states, I almost want to say every state, I can't think of one right now, but if not every state, you pay property taxes. In most cases, most people have their property taxes kind of hooked up with their house payment, and whoever their home loan's through, when they make a house payment, they're also paying a certain amount above their house payment that's going for the property taxes. The company you go through for your loan for your house, they hang on to it until it's time to pay the taxes, and they pay it for you. Because in the state of Michigan, property taxes, at least most of them, are done in halves or thirds. It's done once in the summer, September-ish, and once in the winter, February. And those are usually the times you pay your property taxes. But a lot of people break it down every month, and then the mortgage company or bank or credit union that you went through will pay it in September and February for you. It's called an escrow account. And if you're doing an escrow for your taxes, you're probably doing an escrow for your home insurance. That will get broken down to 12 months, but it's really, the mortgage company only pays your home insurance once a year because they want to get that big discount for you. If you pay in full at the beginning, you get the lowest rate on your home insurance, and they'll pay it for you that once a year thing. So that's, when you hear someone say, my house payment is $1,000 a month, that's very possible that they're talking about their house payment plus their property taxes plus their home insurance. Now, if you ever compare a house payment to rent, you want all three of those because your rent, if you're a renter, anybody here a renter, so I can see if you're getting this? Nobody here's renting. That's impossible. Raise your hand if you're renting, please. There's got to be renters. There is no way, thank you. Two people in this whole room is renting, that's it? No one else pays rent? Wow. When you pay rent, it's the equivalent of a home payment, taxes, and insurance because your landlord is paying those out of your rent. And then hopefully there's some left over for the other expenses that go along.
Leasing and rent are synonymous, aren't they?
Yeah, they're the same thing. If you're leasing, how's that? Did I say the wrong word? If you're leasing, no, nobody's raising their hand. Is this on video? Are we recording? Darn. No one's going to believe it, that no one's renting. Everybody here has free rent? Man, I was such a poor college student. How would I have gotten away without rent? That would have been great. I would have had a lot more money to live off. Anyway, so there's another tax. You're going to, after I get done with the housing chapter, I hope to talk you into owning a house sooner than later, and you're going to have property taxes. But believe me, even though you have property taxes, it's worth it when I show you the calculations on owning a house and the benefits.
So you said that the property tax, if you hear someone say this is how much I pay per month, it's usually the property, the insurance, and what else?
The mortgage itself, the loan that you borrowed to buy the house.
Okay, yeah.
The three of them added together is your house. Most people's house payment is really all three of those together. Because they break it up in 12 months, those other two, the taxes and the insurance. Taxes on wealth. If you have wealthy parents or grandparents and they pass the wealth on to you, you have inheritance tax. There are ways to avoid it, and that is one of the #1 taxes that a lot of people, as they start to get older, do certain things to avoid that tax, such as create trusts. By creating trusts, it allows people to pass on, their inheritance and avoid that inheritance tax. So that's a big one. And then the one we're all familiar with, or almost everybody here should be familiar with, is taxes on earnings. Because you got to do your income taxes once a year. Everybody has to do them. As long as you made a certain amount of money or more and you're a resident, you're supposed to be doing those. So that's the big one. Right? And there's all kinds of ways to pay less of this. And owning a home, when I show you when we get to the home chapter, is one of the ways. Even though it's not as big as a benefit as it was, because the tax laws just changed this year, and owning a home is affected by that change in tax laws. But that's a big one. So there's the most common taxes we all pay. By the way, if you ever own a business, there's another tax. I mean, you have pretty much all these taxes also owning a business. But once a year, you got to pay taxes on all your inventory. Really, it's all of your fixtures, which is kind of a weird tax, but there's that tax too. So you got to take that into consideration. Now, if you look at your payroll check, you noticed, when tax time comes along, you get something like this in the mail. Does this look familiar? Has anybody ever gotten a W-2? Okay, a lot of hands here. Video can't see it, but a lot of hands. You got a W-2. Notice box, where is it? 2. That's how much that has been withheld out of your paycheck, sent to the federal government for your federal taxes. You're filling out a tax form to try to get some of that back, or maybe you still owe a little bit because that wasn't enough. One or the other, usually. But look at box 4 and 5, or 6, excuse me, 4 and 6, it's kind of blurry. Social Security tax, Medicare tax. I don't remember the percentage, but a long time ago when I used to teach tax class, it was 0.0675, I don't remember what it is now. About 6 3/4%. Was it 0.0765? Maybe it was 0.0765. One of these two. That's the amount that's withheld out of everybody's paycheck for the Social Security and Medicare programs that exist. But the problem that's taking place right now, because the baby boomer age group is so huge, is, that they're all getting to the age of being able to receive Social Security or disability. And because of that, there's less money going in than that's going out. There's more money going out in benefits than going in. And so that's why there's this fear that it's going to go bankrupt. I don't know if that will come true. That's been a fear for a long time. But definitely, until the baby boomers die, sorry to say, that's going to be a problem. And really, it's just starting. It's going to get worse. Like a good investment would be adult care homes, assisted care homes, because there's so many baby boomers that are about to get to that age where they need to have assisted care. And that may be, and when you see that, and you know that this is coming, a lot of investors have already jumped on that train and said, this is the future profits, because that's not going to go down. There's way too many people that are going to need assisted living, so that's only going to increase in the next decade, those businesses. And if you're going to start a business and you have like a nursing degree or something, that would be a nice little business to start. You probably don't have to do a lot of advertising. You do not have to spend a lot of money on advertising, because we have right now we have so many elderly that are going to assisted living because they have to, not because they want to.
Don't they have it predicted that Social Security tax is going to cease to exist in like the next 60 plus
that's
years?
That's a possibility.
Okay.
I hope it doesn't happen, but it is a possibility. And when I said to you, your retirement goal needs to be a net worth of $1 million, do you remember that? It's because you can't depend on Social Security when you get to that age as part of your income. It may or may not exist, and even if it does exist, they're going to have to raise the age before you can even qualify for Social Security. That's going to be one thing that will probably be in our future. Instead, right now, you can say, yeah, I'd like to get Social Security now at age, I think it's 62 still right now, or 62 and a half, I can't remember. Or you can pick to wait until you're 67, and I think there's even a third option, to wait till 70 maybe. there'll be no 62 in the future, I predict.
Right.
That will be one of the steps they'll have to take to try to stop all that money that's going out, because, you know, it's like a hump. If you saw a graph of the amount of baby boomers compared to the amount of people, let's say every day, blanky blank thousand people are now on Social Security. Okay, tomorrow another blanky blank thousand. We're at a point where the number going on Social Security is growing significantly every day because of that baby boom age group, which is those that were born from like 62 down to 50, I can't remember, 52 maybe? Right in that area would be called the baby boomers. And so they're all in their upper 50s and 60s right now, and they're all going to be in their 60s and 70s. And that's when all this Social Security is going to start with like a vacuum coming out. And all of us who are, I don't know about us, I'm baby boomer, all of you that are still working aren't going to be able to put in enough money into it to provide all the money that's going to be heading out, because more and more money keeps heading out of it. Will it still be here? I hope so. But right now, do you realize when someone goes on Social Security, they're only getting between $1,000 and $2,000 a month. That's not a lot of money. I mean, it's like at the most $24,000 a year at the most. I mean, the average is below $2,000 a month. So, I mean, even if you take inflation into consideration, you can see what a small portion that it will provide for somebody. Think about what your expenses would be. I mean, you guys don't have a full house payment and paying your own insurance and all this other stuff. Medicare, by the way, insurance that you can get once you reach a certain age, which I think maybe 62 or 65. I can't remember the age for that. You know, that's free insurance, kind of free. There's a copay for elderly people. It comes out of their Social Security. So even when they get their Social Security, there's about $100 a month being taken out of it for this Medicare program, which is health insurance for all the elderly. So, and even that right now, the baby boomers are sucking so much money because they need it for medical care that the money going into that is not keeping up. So that's another program. So you got to add those to taxes you're going to have in your future that you've already experienced. Now I want to add to this story. I don't know if you realize this, but once you reach a certain income for the year, you don't have to pay into Social Security and maybe Medicare either anymore. So for example, I don't remember what that amount is. It used to be about $90,000. So somebody who's making over $90,000, all of a sudden they get their paycheck in November because they made it to the $90,000, but they still got some pays left because they're making more than $90,000. No more Social Security, and I think no more Medicare is being withheld anymore. So that a little more than 7.5% or whatever it is no longer being taken out of their check. And that's another way maybe to save those programs, is to increase that where those who are making over 100 or whatever that amount is still pays in. That would be another possible fix that could be coming so it doesn't disappear. Yes?
Do you think they would take more out of
I don't.
Social Security?
I think people would be so upset if they increase the amount they're taking out. But if raising the age of when you get it and raising the amount that you still have to pay in, if those two don't work, that would be the next one, is more money being paid in by everybody, raising that percent. Now, I want to point something else out. If you're ever thinking of owning your own business, when you get paid from an employer, about a little more than 7.5% is being withheld for your Social Security and Medicare. At that moment, a little more than 7.5% is being taken out of your employer's money and being sent in. Here, the employer goes, here's this much Social Security and Medicare. It's double the amount that was withheld out of the employee's checks, because every employer has to pay in the amount that was withheld from their employees. If you work for yourself, you owe your Social Security and Medicare, and you're the employer for yourself, so you double. You owe over 15%, because you've got to pay both. And a lot of people, when they first graduate, I've had these conversations in the past from students. They go, hey, I got this job offer where I'm being subcontracted. He said, I'm going to work for a heating and cooling company, but you don't work for them directly. You work for yourself. You go out and you do estimates, and then if they buy it, you get a commission, but you're working for yourself. And he said, they're not withholding any taxes. They're not withholding any Social Security, any Medicare. And I said, you better put aside the money, because he had no idea that you would have another over 7.5% when you go to do your taxes in Social Security and Medicare, on top of the Social Security and Medicare you got to pay in just for yourself. So it's double. So if you're ever thinking about taking a job where you're being subcontracted, where you're going to work for yourself, you better say, hey, is that money you're paying me compared to me getting a job with someone else? You know, it better be covering the employer's side of Social Security and Medicare, because if it's not, you've been better off taking the job working for somebody than working for yourself, because you got to pay this additional amount. Most people don't realize this additional amount until they do their taxes that second year after they work that first year working for themselves. And all of a sudden they go, oh my God, look at how much I owe on taxes. And it's because you owe the employer's side of Social Security and Medicare, as well as your own Social Security and Medicare, and federal taxes, and state taxes. So that's a big deal. That's 7.65% or whatever it's at now, the employer's part of it, that's being paid for you by them. You know, that's a lot of money. Take $40,000, your first job out of college is going to be between $35,000 and $42,000, hopefully, I would imagine, maybe. Take that amount, multiply it times 0.0765, and look at how much money that is that you don't realize when you're accepting an offer to work for yourself and be subcontracted. So their offer should be, you know, more than 7.5% higher than the offer you're getting from an employer working for them. Taking that into consideration.
What's the rationale behind us paying taxes for Social Security our entire lives?
And then
just
not
to
get it?
Well, or even just getting it back. Why not just save for ourselves throughout our life? And
In
not
the 60s, when Social Security and Medicare were passed and developed, during the Kennedy era, I think is when it happened. I'm not positive on my history there. But it was all about, they have found so many elderly people who had no income, who didn't know where they were going to live, you know, didn't have any health insurance, and they said, we have to develop a safety net for the elderly. And all of us that are working need to pay into this, and it's going to be for the elderly. So it's always been where people who have started with people that never paid in, getting it, and people who are going to be getting it later, paying in, but you're always covering for those who never paid in later in life. So it's always been a catch-up, because that's how it started. So we're paying in for our grandparents and parents who are going to be getting it. What's going to happen is when you guys get to the age of needing it, it's will your children or grandchildren still be paying in, because they're the ones who need to pay in for you. So it's really everybody taking care of those that came before them. That's kind of the concept behind Social Security and Medicare. It's a safety net. It was developed before welfare was ever developed even. So that's why we're paying in. And the bad news is when that group gets to the age where they've paid in, and now the group behind them, the program gets ended, and they get nothing, even though they've been paying in for those before them. You know, if it does end up ending. And I think it'll still be there. It's going to be such a small amount, you cannot survive off it. You know, it's going to be, like right now, $24,000 you could possibly live off of if you go really cheap in your life. You know, I can live on less than that actually, I go so cheap. But it would be the equivalent, you know, later in life you should say, it might be the equivalent as if you were only getting maybe $15,000 right now. Can you, if you were an elderly person, in today's prices, could you live off $15,000? Well, boy, you'd be suffering a little bit, but you could maybe live off of. That may be the equivalent of what all you may get when you get to the point of needing Social Security. It's going to be that kind of reality of very small amount, barely be able to live off of. So you've got to make sure you're planning for your own retirement and not relying on the government. Or you've got to move in with one of your kids. Yeah, I don't know if that's good or bad. I know I hate it. I don't have any kids. I mean, I hate it if my parents moved in with me. So, types of taxes. That's where we were. There they are. There's the most common. W-2. You saw it. You recognize it. Where's that? I want to point out one more thing. Do you see the box 3 and box 1? Do you see how they're the same number here? 16,500? This person made 16,500 for the year. Now, what will happen when you go work with your degree at this big company and they have a retirement program, those two numbers, box 1, box 3, will be two different numbers. Box 3 will be the true amount you made for the year, and you pay Social Security on that amount. Box 1 will be the amount you made minus the amount you had put into a retirement program, because you don't pay taxes on the money that went into the retirement program until much later in life when you start taking it back out. So box 1 will be a smaller number than what you really made, but that's the amount you have to pay taxes on, even though it's less than what you really made. Box 1. So there'll be 2 different numbers later in life. In box 3, the Social Security wage will always be bigger than box 1, because that's truly what you made. You can't avoid paying Social Security tax. You're just avoiding federal income tax and state income tax till later, and that's why box 1 will be a smaller number, because you don't have to pay taxes on the money you set aside. And that's what I wanted to say about that.
Are there any boxes that show the actual money you get to put in your pocket?
Not until you do your taxes. It's different for everybody. So they're not able to predict that. So what you're saying is you had $2,097.54 withheld out of your check sent to the federal. Then you fill this out, and right here will be whether you get some of that back or not. And I hope one of the strategies that you learn from this class is that a lot of people go, I want the biggest refund I could get, but when interest rates get back to normal, that philosophy is the worst philosophy you could have. My philosophy, once I learned about this whole concept, is I want to owe as much as I can without getting hit with a penalty. That's my philosophy. Because what's really happening is when you have this money withheld out of your check and sent to them, they get to invest it. And when they invest it, they're making, and the example I used to use in the old days was like 5% on your money. And they have millions and millions and millions and millions of dollars of people's money that they haven't done their taxes yet to get the refund, that the government gets to make interest off of. And it used to be, you could take almost no risk at all and make 5%, so that's a lot of money. Once I learned that, I said, well, why am I letting them make money off my money? I would rather make the money off my money. So I went to my employer's human resource office, and you fill out a little form called a W-4, and you're allowed to fill it out. Some employers say up to 4 times a year, some say 10 times a year, some say unlimited. But you can change it at any time. And I went down there and changed mine to have less taxes withheld out of my check. And you could do it in different ways. But the way I did it is instead of putting 0 dependents, is that what 0 is, to have the most taken out? I changed it to a 2. The law even encourages you to do that. And when I change it to a 2, less money is being taken out of every check. And my check that I take home is bigger. But when I go to do my taxes, I don't have that big $2,000 refund coming anymore. Instead, my check was bigger every payday, and I took that extra money and I invested it. And now, for that whole year, I've been adding and adding to it, and I've been making 5% off my tax money instead of them. And I tried to owe them the maximum allowed without paying a penalty so that I can make money off their money instead of them making money off my money. I take their money and I put it in an investment and I'm making money off it, and I don't give them back their money till April 15th, midnight. And I try to make as much money off their money as I can, and then I'll pay it to them when I mail my taxes in. And April 15th used to be the date. I think they moved it up to the 18th or something like that, so that I can make money off their money and my money instead of them making it off mine.
So you'll be paying more when you go get your taxes done?
When I get my taxes done, I'm not paying any more or less. I'm paying the exact same amount, but most people overpay when they have it withheld out of their checks, so they get it as a refund. I underpaid. I'm still paying the exact same tax, but instead of getting a refund, because I underpaid or had less taken out than I end up owing, I end up owing them. But there is, you can only go so far with this. There are these little rules that say if you end up owing more than, I think it's like 10% of your adjusted gross income, I'll show you what that means, AGI. If you end up owing more than 10% of that, you're hit with a penalty. And you do. That pretty much zeroes out the whole concept of what I'm trying to do, because the penalties are so large. So you make sure that you're having enough withheld that you're not going to owe too much. But I try to estimated so that I owe the max I can owe without getting hit with a penalty, which is usually about $1,000 I owe them when I go to write my, when I go to write my, mail my taxes in, which, by the way, I take this even a step farther. I forgot to tell you, I started this a few years ago. I always do an extension. And, well, I take that back. I forgot, I mail a check in with my extension. But anyway, I don't mail that check in until April 15th, and I try to make as much money off their money as I can. So if I owe them $1,000, I've been making interest off their $1,000, and I used to always get a $2,000 refund, so I'm also making interest on the $2,000 now that I don't get refunded anymore. So that's $3,000 that I'm making interest off of that they used to make money off of instead of me. So that's how that works. All right, where are we at? Taxable income tax calculation. This is the. Where am I going here? 11. Here we go. 11. If you got the slide. All right. Tell me, you guys have seen this something like this tax table before. It's like one of the last steps when you're doing your own taxes, whichever form you're using. It says now that you've done this, go to the tax table and figure out what your tax is. And you're going, okay, you probably use the column called single. There's married filing jointly, married filing separately, head of household. If you have children at home, you're unmarried, you're providing over 50% of the support. But you would line up, figure out your taxable income and line it up with one of these and then go to the column and that would be your tax, right? Almost everybody uses this table. I want to show you, and you definitely have a question in your future, where you calculate the tax instead of using the table. And this is how it's calculated. Because a lot of people don't realize they think it's calculated a different way. So I'm going to show you a tax table. Here's the one in the PowerPoint, but this is old, and it changes every year. So I went ahead and got 2017s and downloaded it. And it just looks a little different, but here it is. Are you ready? We're going to pretend the single column. We're going to go with the single column. Look at the different tax rates. A lot of people go with the assumption that if they make over the minimum, that they're going to be taxed at 25%. And they go, darn, if I would have made just a little less, I could have been taxed at 15%. But that's a misconception. That's not how it works. Or someone, you may finally in your career get to a point to where you're making over $91,000, and you're going, oh, I'm going to be taxed now with the 28% tax rate instead of the 25%. Again, a myth. That's a myth. We're all taxed the same on every dollar that leads up to the amount that gets you to the next level. So what I'm trying to say is, everybody who does our taxes in this country, on the first $1 to $9,325 is taxed at 10%. It doesn't matter if you've made over $418,000, it doesn't matter. That first $9,325 for a single taxpayer is paying 10% on that first amount, period. So here's how I want to show you how it's calculated. I want you to give me an amount, we'll take it all the way to here. Give me some number that's between 37.9 and 91.9 that we can pretend this is the example's taxable income. Give me an amount.
50,000.
50,000. Too late. She beat you to it. Okay, we're pretending that we did our taxes and we got to that line item that says taxable income that your taxes are based on. And we're pretending to calculate to 50,000. So the easiest way to do this is figure out where 50,000 lands and make that the top number, replacing whatever the upper range is. Because it's having that upper range that I find where most of the mistakes are made when this question comes up on your quiz or final or wherever this is going to be. Because you have it in your future. So, since 50 is between 37,951 and 91,9, I'm going to shift that range from 37,951 to 50,000 so that I don't get confused. I'm making whatever that taxable income is the upper part of the range that it fell in. Okay, we're pretending we're single taxpayer. You ready? First is, under single, our first $9,325 is taxed at 10%, which is equal to, I'm just moving the decimal over, $932.50. Everybody's taxed that much if they're a single taxpayer, no matter how much you make. So there's the first part of our tax. Next, all of our income between $9,326 and $37,950 is taxed at 15%. No matter how much you made, everybody's taxed the same on that part. So I got to figure out how much that is. So I take 950 minus 9,000, I'm using this number, 325, because this between there is what has not been taxed. Oh, I wouldn't mark it down if you use 9,326. Use either number. What's a dollar? Okay, I gotta find a calculator here because I didn't bring Alexa. Here we go. 37,950 minus 9325. So this amount right here, 28,625, is that what it said? Times 0.15. We're all taxed. If we made over 37,950, that portion in there, we're all taxed at 15%. So there's a big one, $4,293.75. There's that one. But this person, their taxable income's even above that one. So now, because they fell in there, most students will accidentally find the difference between 91.9 and 37,951, but they didn't make 91.9. The amount they made is 50, which does fall in that bracket. The amount above 37,950 is taxed, is the only part that's taxed at that 25%. So I got to find the difference here, which is obviously 12,049, I think. Let me look. 12,049 times 0.25. Can anybody confirm I'm right, or should I go ahead and do this? All right. I hear from no one. It's hard to believe there's this many people in this room and it's so silent. 50,000 minus 37, what did I say? 9, I should use 950. 950 equals, so 12,050. That was close. $1. 12,050 is the only amount that's taxed at that 25%. Times 0.25 equals 3,012 and 50 cents. You add these three totals together, 4293, 4293.75 plus $932.50. Our total tax, $8,238.39, because they don't like any pennies on taxes. They just want you to round to the closest dollar. $8,239. Let's go to our chart. Let's see how we did. What was the taxable income? 50. So we got to go down to 50. There it is. Right there. 50,000. Single taxpayer. Can anybody see that right there? Should I make it bigger? Hang on. What's the number? Right there, right there. What's the number right by that pointer there on the left? 8245. Do you see what using the table does? Now I know that's only $6, but I'm so cheap that I will do this instead of the table just to put that $6 in my pocket. That's how cheap I am.
What was the last step? How did you get there from the 3,000 number?
I added the part of our income
Yeah.
that was at 10%. Part of our income was at 15%, and that last little bit of income was at the 25%, and then I added these three together. And that's how I got to the total tax. We're all taxed 10% on that first part of our income, no matter how much you make. Someone making $1 million a year is taxed the same 10% on that first part of their income, just like everybody else. Now, this brings me to this definition. Marginal tax rate. Marginal tax rate is what would be the percent of tax, federal tax, on the next dollar earned. So let's say we did all this and the year's not over. It's December 31st. And this person has a chance to make $1,000 more. Something took place that day and they could make $1,000 more. What is the marginal tax rate on that $1,000 if they decide to take that opportunity on December 31st? The year's not over. Well, 25%. Because this person is in the 25% tax bracket now, all that's going to happen is their taxable income is going to go up 1,000. And so all that money, there's no, since we already figured out the part that's calculated at 10%, the part's at 15, that next dollar is going to be taxed at 25% because this person's in the 25% tax bracket now. So the marginal tax rate is what will be taxed on the next dollar. It's figuring out which tax rate their taxable income's at now, and then look if they had one more dollar of taxable income. That's the marginal tax rate. So in this case, it'd be 25%, the next dollar earned.
So if your income was $91,900 and you made one more dollar, that would push you up to the next bracket.
Okay,
For the 25%
yeah,
and 28%.
but only that dollar would be taxed at 28%.
Oh, okay. So okay.
Yeah, the rest, all of that below there is taxed at those three levels. Only that $1 would be taxed at 28% instead of 25%.
Does this still apply to businesses and things like that?
Businesses are the same way, but they have a straight tax rate. It used to be 40-something%, and it just got lowered for the first time. The tax thing I went through is all the way down to 35%, I think now. So I believe it, based on profits, straight tax. I don't think there's different levels, levels or not. I believe it's just one level. I don't know if I can't remember if they have brackets. I can't remember. How are we doing? This is the toughest part of today's lecture, is figuring this out. But if you realize, I want to tell you, no matter how much I emphasize this, when this question comes up on your next quiz or final, wherever it's going to be, a whole bunch of people just jump to look to see where the 50,000 lands, and then multiplies it times 25%. But that's not it at all, because part of it's taxed at 10, part of it's taxed at 15. Only that last bit is taxed at the 25.
Will you do this again for us in future classes?
Absolutely. All I got to do is remind me. Okay? All right. So marginal tax rate, tax calculation, tax deduction, tax credit. Before I go there, I want to go to the tax form itself. You ready? Get this up here. Let me see if I can make it brighter. Okay, the top of it, you're on your own. Name, address, school district you live in, blah, 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 blah. Dependents, blah, 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 blah. This section, right here where this dark line is, this is the first section. That whole section's all about income. Income, income, income. Where did it come from? What's your income? What is it? And there's all these different types. If you made income from working, there it is. If you made interest income because you have a savings account at a bank or credit union, there it is. If you made, where's dividends? If you made dividends because you have investments through those mutual funds, you're going to get like a W-2 from the investment company. It looks a lot like a W-2, but it's called a, well, I lost it, 1099. It's just like that. You got to pay taxes on your dividends. It's right there. Taxable refunds. You ever get that thing from the state of Michigan that says, we refunded you this amount? Well, you're supposed to be reporting that as income right there because you got this taxable refund from the state. Everybody just goes, well, I don't even know what to do with this. Well, you're supposed to report it as income. Alimony. You ever do anybody getting a divorce? Sometimes the divorce is where one spouse has to pay what's called alimony to the other spouse for a certain amount of time so they can get adjusted to this single life or whatever it may be because one was more of an earner than the other maybe. Well, that alimony is not tax-free. You got to pay taxes on it. And I can't tell you how many people I've come across who said, oh, no, I didn't know I was supposed to report that. You know, I'm getting that because of a divorce. That's right, and it's taxable. So that's where that goes. On the other hand, if you're the person paying the alimony, you get to deduct it. It's kind of blurry, but right down here is a spot where you get to subtract from your income the amount you sent to the other spouse during a divorce as alimony. So it's just shifting the tax to the person who really got the money from the person who paid the money. So that's another one. What about unemployment? A lot of people don't realize, they remember getting asked this question when they apply for unemployment, do you want taxes withheld out of it? But then when they go to do their taxes, they always say, a lot of people go, no, 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 I want the full unemployment. Then when they go to do their taxes, they forget that, oh my God, I got to pay taxes on all that unemployment. That's right, that is taxable income. It's reported right there. Certain Social Security benefits are taxable. I mean, even that's not tax-free. Almost everything's taxable of your income. Except there are tax-free incomes. One being those municipal bonds we talked about, those are tax-free. Municipal bond mutual funds, those are tax-free. Roth IRA income, that's tax-free. Right? Selling a house that you lived in as your main residence for at least 2 of the last 5 years from the date you sold it, all that money you made off it, tax-free. But the rest are all fitting here. You own a business, a sole proprietor business, where is it at here? It's kind of blurry. Business income, right there, line 12. You got to fill out this whole other form, but we'll figure out your profits, and then you take your profits and report it there and pay taxes on it. Here's one I've got to fill out. Where to go? Rental. I've had a lot of rental properties. I sold them all. I'm down to 1 left, but I still got to do this. I have to do this whole form that shows my rental income, all the expenses related to the rental, and my profit. And then I have to transfer the profit right here to line 17 and pay taxes on it, just like it was income. So there's the first section. You're going to have a question in your future where you're given some numbers, and it's for you to calculate what the taxable income is. What I suggest is you have this in front of you, and you pick out any of the descriptions that have to do with income, and you start there. So you're starting with this section, income. The second section is called deductions. These get subtracted from your income. So your total income is right there at line 22. Deductions get subtracted from your income. Most common is an IRA deduction. Not a Roth. This is an individual retirement account. We talked about these when we were in a chapter. I can't remember. And that is tax deductible. So a lot of people on April 12th will go, oh my God, I owe too much in taxes. I'm going to go do an IRA. They see if they qualify, because if you have a retirement program, there's only so much you can do in an IRA. And they go and all of a sudden they open up an investment. Maybe you get a hold of Fidelity and you say, hey, I got to switch some money out of my investments to the same investment, but now I need to tag it as IRA. Then you put that amount right here, and you get to subtract it from your income. And all of a sudden, your refund's $500 bigger. Wow, why am I getting the $500 refund? Because you put some money into a retirement IRA, and you get the money back in taxes. When you take the money back out of this IRA, you got to give that $500 back because you owe the taxes on it. You don't avoid the tax, you're delaying the tax. Where's the other one? Student loan interest. When you get graduated and you start paying interest on that student loan, make sure and deduct it, because you don't have to pay taxes on that interest. Deduct it from your income right here. There's another common one here. I can't find it here. Hang on a minute. Health savings is so confusing. I'm not even going to mention it. Alimony paid, again, if you're the person paying the alimony to your spouse, you get to deduct it right here from your income. At the bottom, so 2 sections. Income, deductions. Don't confuse deductions with credits. These are deductions, not credits. Deductions get subtracted from your income. Credits, different story. When you get to this line right here, which is that income minus these deductions, you've now reached what's called your adjusted gross income. That number is very important. If you're ever applying for some kind of program that's out there, they're basing it on what was your adjusted gross income on your taxes. That's how they determine whether you qualify for this program or that program. Adjusted gross income. When you go to do your Michigan state income tax form, the first line is, what was your adjusted gross income on your federal tax return? They're talking about that number right there. Line 37, and the top line on the back is where you repeat the same number. Adjusted gross income. It's just carrying it over to the back so you can keep going. So we're talking about these 2 sections today. We're getting to the sections on the back then on Monday of next week. Any questions so far? Hang on, go ahead.
So, you said any refund we get from the state is taxable?
If part of it's taxable, for example, you did a homestead property tax credit, or you did I can't think of that other, earned income credit or something like that, that is taxable, and you get this little form from the state that says, here's the amount of taxable refund you received, and you're supposed to report it on your schedule. I got my form about 3 weeks ago from the state, so if you had money you're supposed to pay taxes on as part of your refund you got from the state, you would have gotten the form by now. All right, I'll see you on Wednesday. Thank you. Monday, excuse me. No holding over the weekend, right?
Your phone.